All right, welcome everybody. Thanks for joining us today. On today's call, we'll be covering different SBA programs, loan options that are rapidly becoming available in response to the COVID-19 pandemic. Our agenda today will be similar to other calls. We'll just go through the ground rules. I'll introduce our experts and our friends from the SBA, and then we'll hear from them, and we'll have a short question and answer section after they're done giving you the updates that they have to give you. Um, a lot of you are familiar with Zoom by now, but for those that aren't, there's a chat function down at the lower left middle of your screen. When you're chatting in there, make sure that the to is selected appropriately. You can either just chat to the panelists, or you can select all panelists and attendees, and that way everyone can see any of the comments that you're making there. Don't ask any questions in the chat window. Put all your questions into the Q&A dialog box, which is also in the lower middle of your screen to the right-hand side. When you're looking at questions in there, if someone's asking a similar question as you, just go ahead and upvote that question rather than asking the same question twice. And you feel free to answer each other's questions if you have some short-term answers in there as well. I don't think we're going to be using the raise hand feature for this particular call, but if we do, and I unmute you to speak, just go ahead and click unmute myself once this dialog pops up, and we'll give you a chance to say what's on your mind. Pretty simple ground rules as always. Just be polite and respectful to our friends from the SBA and to each other. If you do speak, please keep your comments to about 2 minutes, just to allow time for all the questions to be answered. So without further ado, we have two folks with us from the SBA. We have Burl Kelton, who's been with the SBA and worked really heavily in the disaster loan area. Really tremendous experience, so we're very happy to have him on board. We also have Frances Padilla, who's the district director for the Colorado office. She's an expert on the administrative side, and will be speaking on the PPP and some of the other debt relief options that are available these days. So we'll jump off this discussion with Burl. I'll hand this over right now. And again, as the discussion goes, just type your questions into that question dialog box, and we'll start answering those right at the end of their presentation. All right, here's to you, Burl.
All right, thank you, Garnet. To begin with, what I'd like to do is give you a little background into SBA disaster assistance. The agency, that side of the agency was established along with FEMA in the Stafford Act over 50 years ago. We've been doing disasters nationwide and in the territories and islands of the US for the whole of that time. The office that I work out of does everything west of the Mississippi, and currently there are 23 states and 3 territories declared for the COVID event. Of that declaration, each state is declared individually because we do depend on the governor making a request to the federal agency, and then the declaration is made on that auspices. Every small business in the declared state in this event is eligible to apply. Small businesses and private nonprofits are included in that. So for disaster assistance, we have 2, what we refer to as economic injury loan programs. And the short reference that we use is EIDL, EIDL, Economic Injury Disaster Loans. The first one has just recently been established by the CARES Act, and that's the Emergency Disaster Loan, EIDL Disaster Loan, and that's eligible to small businesses with a maximum of up to $10,000, depending on the number of employees. And there is a website that you can go to and apply. Our target turnaround for that is 3 days, and I don't know what the figures are right now, but that's what our target is, and we have had funding already established since that program was started or installed. The other program is the regular long-term. That's the one that we normally have, but it is also an EIDL program, and it has been streamlined significantly, or will be streamlined significantly once we get it back up and running. Right now, there's a major overhaul being done to add IT sources, people to process and respond, and to update our website for access. So we don't have that operating right now, but we'll have news on that as soon as it comes out. But basically that program is a $2 million program maximum. It is a long-term 30-year maximum, and a interest rate on that is 3.75 for small business, 2.75 for private nonprofits. And the EIDL program is intended to recover loss or injury for the time period since the declaration or the event date, which was January 31 of this year. For the first phase, out 6 months. So the forecast is out 6 months, and we look at that in terms of funding. And in that 6 month period, the maximum funding is $500,000. After that phase 1 or 6 month period, then we go into phase 2, and there is more information, your financials and tax returns, that kind of thing, required to move into phase 2, which would take you up to the 2 million if that's appropriate. We look at appropriate credit, we look at your current debt load and cash flow to see how the ability to repay is. We basically look at what it will take for us to get you the money you need within that 2 million max with the debt load and the cash flow that you have. And we look at that situation, that information, as it were, the day before the event is declared. So that's kind of how the program works. Now, we're working in coordination on the emergency disaster loan with the PPP, and Francis will tell you more about that part of the program. But there are some grant opportunities depending on how you use the money and the time frame money is used, and that comes from the CARES Act and the PPP program. So that's really the EIDL program in a nutshell. We look at every particular situation, every applicant on a case-by-case basis. So if you have questions about what your expenses are, what your debt load is, what to include, what not to include, then it's important for you to apply and let the loan officers work with you on that as we go into the processing. We can also make changes during the time of the loan if you become a borrower, and we do that all the time. So we actually underwrite, fund, and service the EIDL loans from beginning to end, direct from the U.S. Treasury. So we're not a through the bank or commercial lender program. We are direct from the U.S. Treasury program, and everything comes out of the U.S. Treasury, and we keep that loan in the disaster agency side from beginning to end in terms of processing. There are no prepayment penalties. The first payment is deferred until the 12th month after the note is signed, and interest begins when the funds are first dispersed. So when you apply and we go through the processing and you are eligible for a loan and you decide you're going to take the loan, then it's really up to you to decide whether you want to take disbursement at that time, delay disbursement, or say, no, I'm really not interested right now. And if you decide to do that, then we still can go back at this time, within 6 months, and reopen the loan for servicing, or if you decide to take it at that time. We are seeing a lot of changes, and it's all related to the CARES Act. So there may be some other details that, if you've had experience with our disaster loans, may change But we'll see that when all the system comes back up and it's available for application. Most everything we do is either by online access or by email. We do have mail correspondence if that's necessary, but the turnaround time is faster if we can use email and online access. So I think, unless there are questions, that's really the two programs that I'd like to talk to you at this point. We can get into more detail as there are questions.
All right, thank you, Burl. No, I think that'll be good. We'll hold all the questions to the end, and we'll give Francis a chance to speak to the PPP and some of the other procedural parts of this.
Great, thank you so much. And I apologize that I'm not on camera. That hardware actually went out on my laptop. Like, sure you can imagine, we've been doing a lot of virtual meetings, but I can tell you that black box, it's probably the best I have ever looked, at least in the last few weeks. So enjoy the black hair. You don't want to see what I look like right now. I'm sure we're all kind of going through that. So again, thank you so much, and thank you, Burl, for talking about the EIDL and what we're calling the EIDL Advance as well. Today, what I'm going to talk about is some of the other provisions of the CARES Act that I'm sure you guys are all anxious to hear about, a little bit on small business debt relief for those of you that already have current and regular servicing 7A or Community Advantage loans. And then I want to talk a little bit about how the state of Colorado and my office at the SBA Colorado District Office is working together, and how we've organized into rapid response teams to be able to assist small businesses and private nonprofits with questions that they have, because I know it's important to try to navigate the space and figure out, you know, what's the best course for you as a small business owner. If you're self-employed or a contractor, do you go the route of maybe looking for some small business debt relief and whatever provision works for you, or do you go the route of maybe, you know, unemployment, maybe shutting down for a period of time and having, you know, encouraging your employees to go on unemployment? Of course, that's a business decision, but let me give you some options to be able to talk that out with somebody. So again, I'm the director of the SBA Colorado District Office here in Colorado, and we're, as you know, the only federal agency, and it's our primary mission to help small businesses to start, grow, expand, and of course, recover, which now we know is of critical importance based on where we stand as a nation today. And we do this and deliver these services not only through field offices like mine, but through an extension of a network of other partnerships, public, private, financial, community organizations, such as our small business development centers, and there are 15 plus satellites across Colorado. Our Women's Business Center, which is at Mikasa Resources, works with all businesses, but their strategic market are women and minority-owned businesses. And then, of course, our SCORE chapters, and we have 2 of them in Colorado. One is based in Denver that kind of covers most of the northern part of Colorado, and one based in Springs that tries to cover most of the southern part of Colorado. So Burl talked a little bit about EIDL and EIDL Advance. So I want to forward over to another program that was reactivated in SBA that you might not be aware of. It's not under the CARES Act. It's just something that's on the SBA books but can be activated in times of disaster. And it's called the Express Bridge Loan Pilot Program. And what this is if you're familiar with any of our loan guarantee programs that are delivered through our nationwide network of lenders, this is another one of the lender guarantees where if they have SBA Express authority, they can take applications from businesses that they have relationships with, and those businesses can get up to a $25,000, basically a bridge loan. And it's expedited processing and expedited paperwork. They can only be made by SBA Express lenders that have an agreement with us in Colorado, and I can definitely share that. And then they need to be working with the client in effect of the date of the applicable disaster, which Burl already went through. So the terms are it's up to $25,000 and basically a revolving line of credit bridge loan. It's a pretty fast turnaround because it's the bank's process with SBA eligibility. That's what they look at on our side. And then you actually can repay in full or in part from the proceeds that you might receive from an EIDL loan that Burl talked about. So what you would need to do if you're interested in this now and not under the other provisions of the CARES Act, get with your lender to find out if they're an SBA Express lender, ask if they have that agreement, or you can go on SBA's webpage, and we have a tool called the Lender Match tool. And right now, I know they're making a lot of changes to it as all the programs are coming online. So just keep trying. So if you go to sba.gov, you'll find a link to Lender Match, and you can kind of go in there and find an SBA Express lender. So that's something that, again, if you already have a banking relationship with someone, it's, I would say, a faster process in the event the lender is willing to do it. So the next program that came out of the CARES Act, which was just signed a little over a week ago, is, most of you know, is the Paycheck Protection Program. So we'll just call it the PPP. What the PPP does is provide about 8 weeks of cash flow assistance, and it's a 100% federally guaranteed loan for small employers and some private nonprofits who will agree to maintain their payroll during this emergency. So if an employer maintains its payroll, then a portion of the loan that was used for covering the payroll costs, but it can also include interest on mortgage obligations, it can include rent, it can include utilities, all of that would be conceivably forgiven after this 8-week period, which would help our employees to remain employed if the small businesses are affected. And hopefully what we're hoping is that this will help our economy to recover more quickly after the crisis. The proposal is actually retroactive. So the loan period would be retroactive to February 15th, 2020, and the 8-week period would go through June. So that would be what we call the loan coverage period. So in the event that you actually did have to lay off some workers, if you agree under this program to bring those employees back on that have been laid off into the payrolls, then you would be able to cover some of those costs and conceivably get some of the loan forgiven on the back end. So I'll just give you a few of the moving pieces, and I will preface this by saying we know everybody is significantly interested in this right now. But although Treasury announced that, here and provided some samples of the program, SBA doesn't have all of the final guidelines. And I'm sure you guys can understand that with all the different industries that are asking questions now, are we eligible? Does it work for this kind of business? Does it work for this kind of nonprofit? I'm glad that SBA on some level is being just a little bit deliberative, because I don't think we necessarily want to be the fastest, but we want to be correct. I think we owe it to America's small businesses to be correct when we finally roll out all these guidelines. So if you call our office or you call your lender, or even our lenders are calling us right now because of the announcement by Treasury, what we're saying is we're waiting on the final guidelines. And that is true. Nobody's holding back any information. Nobody's hoarding any money at the banks. We are truly waiting for the final guidelines so that we can be as thorough in explaining and giving all the definitions of how this works, so that we can move faster and get loans through as fast as we can once it's finally opened up. What Treasury announced is that we would start this application process, or it would be open on some level by April 3rd. I'm hoping that we have final guidance, and then we can definitely get everyone trained in the field to be able to provide technical assistance back to small businesses and perhaps some private nonprofits that want to apply for this. But in essence, here's what you could use PPP for. So it's for small employers that have 500 employees or fewer. If you're in an industry where the size standard for SBA would have been larger, you can actually default to the larger number of employees. That happens in some cases for some manufacturers, but for the most part, the rule of thumb is 500 or less employees. This covers self-employed individuals and gig economy individuals. There are certain nonprofits right now that were specifically mentioned and carved out in the Act, and those are 501c3s and 501c19 veteran organizations, and then tribal enterprises, not the government, but the enterprises. The size of the loans would basically be 2.5 times an employer's average monthly payroll. And then the lesser of that, or the maximum loan amount for any one borrower, would be $10 million. And so what could be covered in the payroll costs would be salary, wages, even payment of cash tips. And we would max that, or put a threshold of an annual pay rate of up to $100,000 per employee. So we wouldn't pay anything for anybody who is making money $100,000 or more a year. Other things that can be rolled in are employee group health care benefits, including the insurance premiums, retirement contributions, and then some covered leave. The program now, that as it was rolled out, is going to be the same across the board, and what they offer for every client. The borrower nor the lenders have to pay a fee to participate in the program. There's an automatic deferment of the payments for at least 6 months. If in the end the crisis is extended and we need to go back and do modifications, the Act actually allows for up to 1 year. But right now it's set at 6 months deferred. The interest does accrue in that time frame. So all the loans in the program are going to have these identical features. The interest rate of anything you would pay back after that 8-week period would be 0.5. So half of 1% is the interest rate. The maturity for anything that would roll into a payable loan portion would be 2 years. So a 2-year maturity. Again, the first payment is deferred for 6 months. It's 100% guaranteed by SBA. So that's basically an insurance policy back to the lenders that say, heaven forbid, something should happen and you would default on any of the part of the payable portion of the loan, the SBA would come in and make everything whole. So that's the incentive for the lenders to make these loans. There's no collateral required on this one. There's no personal guarantee required on this one. And again, no fees payable to the SBA anyway. So the delivery system, unlike the EIDL program, which is a direct lending program through our Office of Disaster Assistance, this loan is distributed and made through guaranteed lenders throughout the country. Right now, it applies to federally insured institutions, which would be banks, and likewise, also credit unions that are insured that already have an agreement with the SBA, and conceivably Farm Credit Administration institutions. In the next iteration of the rules, the SBA and the Treasury also have the authority to onboard other lenders that haven't participated in SBA, and they're committed to making an expedited process to that. But right now in the nation, we have about 800 existing participating lenders. That's banks, credit unions, and other financial institutions that already have a participating agreement with SBA. So specifically to Colorado, I would say we're saturated in terms of our agreements. We have about 90 to 95% of all insured institutions, excluding credit unions, that already have an agreement, a participating agreement with SBA and are in good standing. So what we need to know now is we're waiting again for the guidance and the iteration of the final rules for the banking side of the house so that our lenders know, A, how to opt in, B, how to process any of the applications that are coming through, and then see what the risk mitigation is to them. So we need all those rules before we actually start rolling. And in the guidance from Treasury, there are some application start dates. One of them is April 3rd for most small businesses and sole props. And then another one that has been quoted is April 10th, and that would be for independent contractors and perhaps self-employed individuals. We'll see if those stand at the end of the week. As I said, that was, a quick rollout from Treasury. We're waiting for SBA rules on that. And so, again, other regulated lenders, we might be made available to provide these loans as soon as everything is approved and everybody's enrolled in the program. The other thing that the Act did was it changed the maximum loan amount for regular SBA Express loans. These are normally revolving line of credit and working capital loans that are shorter term. So they had a max on them of $350,000 for a line of credit. Well, that changed that to $1 million. So if you have a line of credit now, or you are seeking an SBA Express and you're in a different credit situation for your industry, you could actually go to your banker for either the Express Bridge loan now, or you can ask for a regular SBA Express beyond the maximum that already existed due to the CARE Act. The other thing that the CARE Act asked SBA to look into was what we call small business debt relief. And that is for those of you that already have SBA loans, 7A right now, and Community Advantage. We're waiting on the green light on anybody who has a 504 loan. But right now, lenders have already been instructed that, or at least advanced messaging, if they have a current a 7A borrower or a community advantage borrower, SBA will relieve any obligation to pay principal and interest and associated fees that are owed on those 7A loans or those community advantage loans for a period of 6 months. So it could begin with an April payment. Right now, SBA is working on that whole system and how that's going to be rolled out, but we did do some advanced messaging to our lenders that said, start getting ready, and what we want you to do is gather the information we would need to be able to start making those regular payments for 6 months to give you guys a little bit of a relief on your current SBA debt. The caveat is that debt, that loan needs to be in good standing right now. So, or maybe not today, but at least through the beginning of the act when the covered period started. So I would say from at least February forward, if you've been paying regular scheduled payments as agreed, then you probably will be eligible for the small business debt relief. There's nothing you need to do other than just make sure that you're keeping your payments current until SBA starts making those payments for that 6-month period. So that's what I have on small business debt relief. I know there's probably a lot of questions, but I think my last remarks are going to be centralized around what are the other resources and communications and business navigation that's available in Colorado. So from the very beginning, I usually akin this to either describing the Big Bang Theory or describing the creation story, however you look at it. On day 1, the president came out and he said, this is going to happen. On day 2, we rolled out all these EIDL loans. And day 3, that process changed. On day 4, we added advance. On day 5, the CARES Act came out and added these other provisions, which were catching up to write the rules. And now on day 6, we have all these other resources that are coming in. And from the beginning, at least from my office's perspective, is we wanted to have one centralized place, repository, and rapid response team that can be mobilized across all of Colorado to help small businesses that have questions and trying to figure out how to navigate all these programs as they're rolled out, and then the landscape, and whether or not, like I said, to go for unemployment or to encourage your employees to go for unemployment for a period of time, etc. So we're working really, really closely from the very beginning with the state of Colorado, the governor's office, the Colorado Office of Economic Development and International Trade, our Colorado Small Business Development Centers, our Women's Business Center, our SCORE chapters, and various and sundry local resources like economic development organizations and trade organizations and chambers that are more regional or local. And we have established at the state level a small business navigator hotline and an email for businesses that want to seek general guidance and information on access to capital programs, workforce development concerns, or other areas that you're affected by. So this navigator hotline is stood up by the governor's office under EIDL, and they are answering questions Monday through Friday from 8 a.m. to 5 p.m. Mountain, or you can reach them by email. So let me give you that hotline. It's 303-860-5881. Again, 303-860-5881. Or the email is OEDIT_SBA Navigator at state.co.us. And I'll send this all to the association so that you'll have it. But it's OEDIT_SBA Navigator at state.co.us. Also, you can sign up for COVID-19 email updates from OEDIT. They are regularly communicating whenever a state program or incentive comes online. There's another rapid response team, not just the SBA and Capital Resources one, but there's also another one that's gathering information as local authorities are developing programs and incentives and putting it into one repository and trying to get it as regional as possible to make that easy. So if you visit OEDIT's webpage, there's a COVID-19 Business Resource Center launch page, and that will get you to the most recent news and resources for the whole state. The easiest way to get there is go to choosecolorado.com. That's the launching page for the state, but you'll also see scroll bars about and headers on COVID-19 coronavirus information. You can click on that and it will take you to the COVID-19 Business Resource Center. So one of the things the Navigators Hotline will do is it'll talk with you about workforce stuff, and then also it will connect you with either a small business development center, mentor, a SCORE mentor, a Women's Business Center mentor. All of these are no cost and free. And we've been training them and keeping them up to date daily to know what we know and be able to answer questions and then again navigate you into a consultation relationship with an SBDC or one of the other resource partner mentors so that you can bounce ideas off of them. They can help you with applications. We keep them up to date on the EIDL processes, and so that you can develop that relationship. Because one of the things that, especially under PPP, that will happen is there's an element of principal forgiveness or loan forgiveness for that 8-week period that you're agreeing to cover payroll or reboarding people. If in the time you can't keep your employees or you can't keep that dollar level of payroll, there may be a reduction in the principal forgiveness proportional to who you had to lay off. Well, you want your mentor or your counselor or your consultant to be there with you when you're calculating it on the front end, and then also when you're calculating it on the back end to ask that portion of the loan to be forgiven. It's a bad time to try to get a consultant when you're in need. It's like anything else you want to have in your toolkit. Your banker, your lender, your accountant, your bank, your legal advice. Same thing with your consultant. And because it's free of charge right now, we're paying them to help you for free. You might as well avail yourself of a consultation appointment. And if you just want to not go through the navigator, you can go to coloradosbdc.org and you'll find all the different 15 locations. Right now, we're a network without walls. So you can pretty much make an appointment with almost anybody in the whole SBDC network. But if you want to kind of keep it in your neighborhood, you can go there and find the SBDC that serves you. And I think that's all I have, which is a mouthful. Sorry about that.
No, that was tremendous, Francis. Thank you so much. We'll jump into questions, and a great segue because one of the last comments you made is one of the most popular questions we have about that forgiveness period of the 8 weeks after loan origination. What happens to a business? So this question is if people are able to keep their full-time employees through that 8-week period, and then week 10, week 12, their businesses just aren't recovering for whatever reason. Are there any good faith problems there, or is there any potential repercussions if you have to lay off staff after that 8-week period after the loan origination date?
The answer to the question is until we have the full rollout of the guidance, we don't know what's going to happen right now. We have the outline, we have the bones of the program, but we don't have all the meat on the bones. So, stay tuned.
Looks like we might have lost Francis for a little bit. If you can hear us, just...
I'm on.
Oh, okay.
I'm back on. Sorry about that. Yeah, I had a little blip in the, how it goes. It had a little
Yep.
blip. Did you hear the answer at all, or was I
No,
dead?
if you're able to repeat it, that'd be great. I think, we had a little, I think the last thing that came through was just a little bit of uncertainty about what the rules are actually going to be.
Right. So right now, the skeleton to the program, not the meat on the bones, but the skeleton says that we're going to be looking at that 8-week period, the loan covered period. But until the final guidance rolls out, we don't know if there's any recourse beyond that.
Okay. And I guess another question that kind of piggybacks on that is there anything a business can do if they're trying to rehire all of that full-time staff, but for whatever reason they can't? People's lives change or they can't get a new hire. Is there any recourse for businesses that just don't have, that just doesn't happen for them? Or is it a pretty strict rule, at least as it's written now?
So it's not strict in the sense of how the calculation is done. And again, I don't have the formula for you. It's secret squirrel sauce right now. But as soon as we do, we'll let you know. But in essence, what we're going to be looking at is whatever period back in time from a year ago, what was your payroll level, either on a dollar basis or on an FTE basis. So there's still an opportunity there. It might be by dollar that you're comparing dollars to dollars per year, or it could be, on an FTE basis.
Okay, and this is probably an answer to this question will be in the same vein, but about that forgiveness period, it looks like one of our members saw a clause in a contract he's been working with his local lender on that says, due to likely high subscription, it is anticipated that not more than 25% of the forgiven amount may be for non-payroll costs. So it sounds like some of that forgiveness usage and the forgiveness amount itself is still to be determined, and there aren't some exact rules at this point. Is that correct?
There are some examples of what can be rolled in, and I think I already kind of went through some of them in terms of wages and commissions and tips, and some rent obligations and lease obligations, utilities. But yeah, it is true that if you spend 75% of those loan proceeds on the eligible payroll costs, as they will be defined, then you stand a chance to get the full loan forgiven. If you don't, then whatever is the balance will revert into the payable loan.
Okay, great. And then, yeah, important to remember for everyone as well, there's right off the gate, there's a 6-month deferment on this as well. Let's see. Yep, another question about that amount. So I think that answer is sufficient there. Yeah. So this is a great question. You touched on this like really briefly in your answers before, but there's a lot of communication about the 7A loans. A good number of our members will have 504 loans on the real estate side of things, especially. Do you have any feeling about how the 504 loans will adapt into these programs, or is that another thing that's still kind of to be determined at this point?
Well, I can tell you that the CARES Act, the way that it was written, it gave SBA the flexibility to make some of those payments for 7A, Community Advantage 504, and also SBA microloans. Right now, we've only rolled out advanced guidance on 7A and CA, so the rest is to be determined. Okay,
great, thank you. And for the staff, let's see, I'll just read this question as written, and then this might lead to a little deeper discussion as well. This member is trying to keep their staff. Do they want to know if they need to lay them off and then bring their staff back to be eligible?
So I'm assuming we're talking about the PPP.
Yes.
First of all, I would say talk to a navigator and get with a consultant and help figure out all the scenarios that might work best for you as a business owner. That'd be my first piece of advice. But what the Act says is that if you already laid them off, and we're talking about, again, the covered period, February 15th to June, if you already laid them off and you agree to reboard them, then you could apply. Yeah. And at least you're going to use some of those expenses, yes.
Yeah, and I believe that's true for laid off staff and furloughed staff. You can bring them back on. If I'm not mistaken, that has to be within 30 days after the CARES Act passed. So maybe April 25th, you'd have to reinstate their salaries by that point. Is that correct?
That's the date we've been looking at, yeah.
Okay, great. All right, and let's see. If qualify for the 6 months. Let's get a question for, this might be for you, Francis, or for Burl. So how do EIDL or PPP loans impact current SBA 7A loan applications? We probably have a number of gyms out there who are currently in the process of getting a 7A loan, or a 504 for that matter. Is there a chance that securing either an EIDL or PPP loan would negatively impact the prospect of securing a 7A loan?
Burl, if you want to answer on EIDL, I could probably take a stab at the rest.
Well, as far as my information is, that would not impact the EIDL loan. And it's important to know that the emergency EIDL can be accessed at the website sba.gov, sba.gov. There's a yellow banner at the top of the screen. Click on there. It takes about 15 to 30 minutes to go through the process.
Okay. And
so from my perspective, I think, sorry, Beth, I was just going to say, from my perspective, I think the real question, it's a business decision, is do you have the ability on the 7A side? Because nothing's really relaxed on the regular 7A side as far as I know. Do you have the ability to repay that debt at that level? So that's a business decision.
Okay. And I think this question also was speaking to if someone were to secure an EIDL, would that negatively impact their ability to secure a new 7A loan or one that they're already actively working towards?
And as far as I know, no, but let's say it's not an EIDL advance, but an EIDL disaster loan, we're going to look at the totality of your debt.
Okay.
So, I mean, the repayment ability is the question.
Okay.
Yes, in terms of the long-term EIDL, we do look at debt, and that would impact a decision on eligibility.
All right. Let's see. Okay. Yep. So this is like another nuanced question around that. So someone who has a current SBA loan, I imagine this probably is a 504 loan. It might be a 7A, who's opening up a new facility, and they haven't fully funded their loan yet. So they're looking at what the best way to cover expenses are with the SBA. They have expenses around the construction, then also expenses that are mounting since they aren't able to stay in operation. And they're not qualifying for the payroll loan at this point, probably because they don't have staff at the moment. So it sounds like EIDL might be a better option for them. Would you have any advice on that, Burl?
Well, the EIDL would be good. However, the long-term loan process is not available at the moment.
Mm-hmm.
So in terms of immediate assistance, it probably wouldn't be help. But once that site is back up again, they should apply and see what they're eligible for. The EIDL is going to cover operating expenses. So that would be outstanding operating costs and expenses, and then forecasting out during the recovery. So that would be a consideration. It's not up at the moment, but when it comes up, then it would be good to look at that.
Okay, thank you.
I think the other thing I would add to that is if you're already working with a CDC, and especially if it's a 504, they've already been given trade and SBA instructions from policy, and I don't have it in front of me, so I really couldn't speak to it specifically, but they've already been given instructions on deferments and flexibility that was outside of the CARES Act. So if it's stalling the completion, should probably work with CDC to figure out how to time that better. But almost none of the programs that have been rolled out, not the EIDL disaster loan nor the PPP, you're right, will pay any of those capital expenses. We can't really spend any of this on assets. So they really have to kind of balance, you know, when do we close on this? Do we close on this? Because you cannot close if there's an adverse change. So they need to work with their CDC or their lender on, you know, the rigmarole and all of the mechanics on a deferment or to delay, if that's what they choose to do.
Okay, no, that's really interesting. Maybe think of one other angle on that, which is if you are able to get into the PPP or get an EIDL, those funds could be used to pay for any SBA loans that aren't able to be deferred or forgiven for any reason. I believe that's correct.
Well, Garnet, no, the long EIDL cannot pay off other SBA loan. You can make payments, the payments that are on those loans, but not pay off those loans.
Oh yes, yeah. Sorry, I should have been a bit more specific there. Yeah, but you can use the EIDL loans and potentially the PPP to pay those monthly payments during that period.
Correct.
I would caution people until we have the final rules on PPP to try to even think of structuring that way, because if they're already let's say they're already a 7A lender, they're getting debt relief in the form of 6 months of payments anyway. So we just don't know yet if you could double dip.
Mm-hmm. Okay.
Yeah, that is one caution that probably needs to be repeated, that you need to have all the details before you make a final decision, and just recognize that details are still coming. And like Francis said, we're not hiding anything. We're just making sure that when the information is available, that we have the correct information and it's accessible to folks that are affected.
Yeah. I'm going to make an attempt to lump a number of questions together. And all of these have to do with the way that full-time employees are defined and the way that the amount of payroll is calculated for the initial PPP amount. So it we're a lot of the climbing gyms are pretty heavily utilizing part-time employees. So one of the questions is whether part-time employee salaries are going to be used to calculate that initial loan amount for that 12-month average. And let's see, the second half of that question is how those full-time employees factor into that 8-week period as well, whether there's any consideration given towards part-time employees that are able to be retained in that 8-week period after the loan origination.
So again, I'm going to preface this by saying we don't have all of the rules and all the definitions, and truly in this case, the devil is in the details, specifically because we do need those calculations. We need that secret sauce, right? We need all those formulas. But in essence, what the Act said is it does give some consideration to full-time equivalents, not necessarily full-time employees. So doing the calculation for full-time equivalents would mean whatever level of part-time and full-time that you have. That's all I know for now until we have the formula.
Okay, great. And for the PPP specifically, any portion that isn't forgiven, what's the current interest rate on that? Some people have heard 0.5%. Is that the right number?
It's 0.5, half of 1% amortized over a 2-year period.
Great. So another question about full-time employees who've quit prior to the shutdown, whether those payroll amounts are going to be used to calculate the loan, the initial loan amount for the PPP. This is probably another question where we don't have the exact formula yet. But my understanding, and correct me if I'm wrong, Francis, would be that it's your average payroll for the last 12 months, and that is your full payroll of full-time employees.
Yeah, and I know we're looking back 1 year, but it's your average monthly. Yeah, so I think we'll be looking at what your average monthly was. Again, I don't want to speak out of turn until we have the formula.
Okay, and I'll throw this one at you too, because it might be the same answer. So if 75% of the PPP loan is used for eligible expenses, is there any guarantee the loan will be forgiven?
I mean, there's a guarantee to the lender that this is a 100% guarantee, but I think that's why we want all of the details so we can set you up for at least the best chance of success on the front end. If you do follow the rules and you sign all the certifications, then, to the extent that the money is there from Congress, I don't see why it wouldn't.
Yeah. And is there a current definition that you think will be likely for full-time equivalency? Is that hours per week?
Do not know.
Okay. Good to know. And we have a lot of questions coming in about that April 25th date and what that means to bring your staff back or reinstate your staff by that date, and why that's a portion of this. And I think a little bit of confusion out there as well between that reinstatement period, between when the CARES Act passed and 30 days, and what the 8-week from loan origination date is all about. Could you offer maybe some clarification between those two different time periods?
Sure. So in the Act, it says the loan covered period, and that's where we're going back and counting like what you can use the costs for. For instance, here's an example. You're definitely going to have payroll costs, including benefits, right? We're going to look back at interest and mortgage obligations incurred before February 15th, rent under lease agreements enforced before February 15th, utilities for which the service began before February 15th, and then from February 15th to June is that 8-week period. That's the covered loan period that would conceivably be eligible for principal forgiveness or loan forgiveness. So I'll calculate all those expenses, bringing all the people back on, that's kind of the set period. That would be let's just say the lump that you would try to hit to ask for principal forgiveness or loan forgiveness. Again, when we have, it's all pure speculation on my part, how all the formulas are going to work. I know everybody is dying for this information so you can start calculating it now. I just don't have it. And I don't want you to do you a disservice and you do all this work and then Friday, the formulas come out and it says something different than what I'm saying today.
Okay, wonderful. And then another kind of nuanced question on that, but an interesting one with that answer. It looks like someone has a PPP application, and there's an ask for a number of jobs. Would that be the full-time equivalent jobs that are looked for, or the total number of jobs in a business?
I assume so. And let me speak to that application. That application is actually posted on Treasury's website. And then when SBA mounted our material, we posted it with a big fat sample across it. So we put that out there as a sample so people can understand, here are some of the questions we might be asking you, but we still don't have all the definitions on how to calculate.
Okay. And another question specifically for the PPP. Someone's wondering how that works in conjunction with the COVID-19 payroll tax credit, if there's any overlap there, or any considerations to be made in your planning.
I don't know on the tax side, but I know that we're going to be talking to our friends at IRS to see how that matches up once we have formal guidance.
Yeah. I think one tax area we could touch on here is, from what I've read, it looks like any of the forgiveness that could potentially come through the PPP will not be taxed as income. Is that correct?
That is correct. That's provided under the Act.
Great. Let's see. So we've got a number of questions here about the forgiveness and debt relief programs as well. So it looks like one of our members who has a 504 loan was told that that he's going to be given 6 months of full forgiveness, principal and interest on his loan. He's wondering if that's final. His lender, I guess, made it sound a little bit more firm than we're hearing on this call.
Yeah, I don't know if he heard that from the CDC side, which is the agent that works on behalf of the SBA, or if he heard it from his third-party lender, which holds the first mortgage. But if it came from the CDC, we're all kind of working in verticals in terms of information. So they have their own trade organization as well that's trying to get information down. Like I said, we've only advanced information to the 7A and the CA lenders. Formally, at least from the district offices that we were provided from headquarters. I've not seen the advanced instructions on 504 or microloans.
Great. And let's see, so a follow-up question on that, for anyone who hasn't already been in touch with their lender, where's the best place to go for information on any of the possible debt relief programs and options that are out there?
So I would say, like I said before, we're trying to organize into verticals and have one repository. So if you visit the state's webpage, you'll find most of the latest information from SBA. But the easiest way to get updates from my office is to subscribe to our email newsletter, and I'll make sure that you have that. It's really easy. Just quickly, you go to sba.gov, you click on Newsroom, and then Newsroom will populate a page that will allow you to subscribe to a bunch of different e-newsletters in SBA. One of them could be the national newsletter, and one you can scroll down even by zip code and subscribe to just Colorado District, or if you're also in Utah or whatever, you can subscribe to our e-newsletters. Or you can follow us on Twitter, because just as soon as we know there is something available, again, I'm not holding back information, I'm not hoarding it. We automatically post on Twitter in our hand, or at least say this is available and give you the truncated link to the information. So our Twitter handle is SBA_Colorado.
Okay, wonderful, thank you. And it looks like we might have a couple of people out there who've already entered into deferral agreements for some of these loans. Would any existing deferral agreement impact their ability, or I'm sure this is still to be determined to some level, but would you imagine that their deferral agreements would impact their ability to enter into any of those debt relief programs?
I don't know how those are going to interact yet. I'm guessing that they won't be concurrent periods if it is available to both do the deferment and then get a second one, then the relief of the payments, but TBD.
Okay. And let's see, let's get Burl in here a little bit. We've got a question about EIDL loans. Someone's been approved for an EIDL, and they're still waiting to sign the documents. They want to know like how those funds are delivered and how best to document how those funds are being used.
Well, they're typically delivered electronically, so we have your deposit information. We can send that directly. And as far as keeping track, they would just account for it as they normally would in their whatever accounting system they use. I had a question the other day if they should someone should open a separate bank account. And no, they don't need to do that. Just make note of the fact that that money is coming from that source on both cases, and that should take care of it.
Okay. And when it comes to documenting how those funds are used, is there any anything above and beyond normal accounting procedures that people should keep in mind?
Not that I'm aware of.
Okay. Well, we're getting to the top of the hour. So thank you very much, Burl and Francis, for joining us today. This is incredibly informative, and I'm sure a lot of people here are as appreciative as I am.
Could I give you one? I did have a
yes,
question
please.
on rehiring. I just want to give you this because it's a nice little tidbit and it kind of explains the dates a little bit better. So on rehiring, according to the Act, I haven't seen the rules. According to the Act, an employer would have until there's that loan covered period, right? February 15th through June 30th. The employer would have basically until June 30th to restore all their FTEs and their salary levels for any changes that were made between February 15th and April 20, the end of April. That's the end of April date. So if you made changes to your payroll between the 15th and the 26th of April, you have until June to restore them to the prior year status.
Okay. Yeah, that's a great clarification.
Mm-hmm.
Oh, thank you. Yeah, and we have a couple of questions. Oh, sorry. Go ahead.
There's a lot to think about. It's really important for folks to jump into it at this point and not wait, as far as just getting their own situation in mind and in order so that they can be prepared.
Okay. Yeah, and so we have a number of questions that we weren't able to quite touch on. We'll keep publishing articles and getting information out to you guys to keep answering these questions as some of these formulas and processes are developed and become more firm in their methods. And then we'll definitely keep an eye on the SBA sites as well to make sure that any updates there are communicated to you in real time from us. There are some other things that you guys out there can do to help us. We're working towards our advocacy efforts. It'll be really helpful to have good data about our industry and the overall economic impact of COVID-19. I know you guys have seen the link to our survey on some of the previous calls. If you haven't had the chance yet to go in there and fill that short survey out, it should just take 5 or 10 minutes at the most to gather all the data. It'd be a massive help to every climbing gym in the U.S. And I'm going to hand this off to Laura to talk about our next webinar, which will be coming up on Tuesday.
Thanks, Garnet. Yeah, so we have an exciting call coming up on Tuesday. We're going to be talking about member engagement, ways to stay connected with your members while your gym is closed, and creative ideas to help generate revenue during your closure. We've got Hillary Harris from Evo Rock and Fitness, Sharon Cooper from the Cliffs Climbing and Fitness, Brad Werntz from Boulders Climbing Gym, and Alice Cow from Sender One Climbing to talk about what they've been doing, what's been working well for them, and we'll get into some of the nitty-gritty of how to pull some of these creative ideas off. So that is coming up on Tuesday on our weekly 2 times a week calls. And as always, we're here for you guys. Our contact info is up there. If you want to get in touch with any of us, feel free to reach out with questions, suggestions, concerns, anything that you need. And again, our resource hub for coronavirus related information is located on our website at climbingwallindustry.org/coronavirus. So that's going to be your best centralized location for all of the resources that we're putting together. So with that, I think we will leave it there for today, and thanks everyone for joining us.